Hi there, welcome back to my channel. I'm Stocky with today's topic, that is hedging strategies. So, let's move on with it. Before that, for those who are new here, or have no idea what hedging is, please check out my hedging video. You would find the link in the description below, or right above. The video is available. In the stock market, hedging strategies act as a protective measure for your stock portfolio. They involve taking an opposite position, long or short, to help minimize potential losses in your existing investments. Think of it like having insurance. It shields you from the risk of losing all your money. Retail investors employ stop-loss strategies for risk mitigation, while institutional investors use hedging to safeguard their investments against potential downsides. To hedge a position, an individual may short a stock similar to the one they're buying. This way, if the overall market declines, the short position's profits counteract losses in the main position. Short selling allows individuals to profit when a stock's value decreases, rather than when it rises. Various hedging methods with distinct advantages require different financial instruments for implementation, each mitigating varying levels of risk. Investors can optimize results by employing a range of approaches. Hedging techniques find diverse applications. A tech company might hedge currency risks, while a construction firm may hedge against fluctuating material prices. Various industries employ hedging strategies to navigate specific challenges and uncertainties. Let's see an example. In financial trading, consider a scenario where an individual investor purchased 1,000 shares of XYZ stock at $50 each. After some time, the stock's value drops to $40. If the investor believes in the stock's long-term potential, but wants to limit immediate losses, they could use a protective put strategy. This involves buying put options on the same stock, providing a safeguard against further declines, while allowing them to hold on to the stock for potential future gains. Puts offer the ability to sell stock at a predetermined strike price throughout the contract period. For instance, they might opt for a put contract with a $45 strike price to shield their portfolio from further losses below $45 throughout the contract's duration. It's important to note that once the contract expires, it loses its exercisable status. Traders and hedge funds employ various hedging techniques, including market-neutral positions. Example: a trader allocates $40,000 with $20,000 in a long position for stock A and $20,000 in a short position for stock B. The aim is to offset potential losses in one stock, with gains in the other, strategically based on their rising or falling potential. Long-short equity strategy. Example: similar to market neutral, an investor goes long with $30,000 in stock C and short with $30,000 in stock D, emphasizing undervalued and overvalued stocks, respectively. Pairs trading strategy. Example: taking a long position in stock E and a short position in stock F, both correlated. The strategy involves capitalizing on divergences in correlation, anticipating a later convergence. Hedging with derivatives. Example: utilizing derivative contracts like forwards, futures, and options for hedging. Institutional investors commonly use futures and options to manage risk in their portfolios. Diversification. Example: rather than concentrating all investments, an investor diversifies with uncorrelated assets. This includes building a portfolio with varying amounts in stocks, bonds, commodities, and other assets, to mitigate losses in one area, with gains in others. This was the main part. Apart from this, just as an idea, let me explain two more areas, or you can say compartments of stock market. where hedging strategies can be used, that is, derivative hedging strategies, which involves using contracts like forwards, futures, and options. For instance, an investor holding a long stock portfolio may open a short futures position to hedge against potential downside. Hedging strategies, commonly used by institutional investors, include buying protective put options to mitigate downside risk and selling covered call options to offset stock holding risks. Now, let's have an idea about different hedging strategies. Hedging trading strategies come in various forms, such as covered calls, where selling a call option is a partial hedge against potential unlimited stock rises. Tail risk hedging includes using put options, shorting futures, and applying Nassim Taleb's barbell strategy for an anti-fragile portfolio. Sometime in the future, I would surely like to cover such concepts in separate videos. So, stay tuned and subscribe to my channel for updates. Now, continuing with the next brief strategy. Pairs trading strategy involves taking opposite positions on correlated stocks. For example, going long on stock A and short on stock B, capitalizing on their converging prices. Long-short equity strategy, similar to pairs trading, combines long positions in rising stocks and short positions in weaker ones, relying on the performance difference for profit. Quantitative analysis, pioneered by Edward Thorpe, is often applied in this strategy. Don't worry much about the new terms you get into here, since only a brief idea about all is sufficient to start off with. Diversification, a simpler approach for retail traders, involves trading different asset classes, time frames, and market directions to spread risk. After getting little idea about hedging strategies, let's get to the main question. Which is the most profitable hedging strategy? Well, in the long run, of course the most working and hence profitable strategy is diversification. The more you diversify your portfolio, the better your profits are, compressing the losses at the same time. Okay then. That's it, folks. This was an idea about hedging strategies. See you next time with a fresh topic. Till then, keep trading, keep learning, and don't forget to diversify.